The market just dropped 20%. Your portfolio is down thousands of dollars. Every financial headline is screaming the same thing: disaster. And this is not some ordinary disaster. For many people, it feels like a financial nightmare unfolding in real time. Meanwhile, almost everyone around you is doing the exact same thing: selling, panicking, and most surprisingly of all, getting out of the market before things get even worse. But what if doing absolutely nothing, no action, no changes, no selling, no panic, was actually the smartest financial move you could make? And what if the people who panic and sell are the ones who permanently lose money, while the people who do nothing end up wealthier in the end? Why does that happen? And how does it happen? This topic is so important that we're breaking it into two parts. In this first part, you'll discover what actually happens to your money during a market crash when you do nothing. Does your money keep shrinking? Or does something completely different happen? And in part two, we'll uncover the psychological reason most people panic and sell at exactly the wrong time. And you'll understand why this single decision separates people who build wealth from everyone else. Most people believe a market crash means losing money. And to them, that's the entire story. The numbers go down. The losses feel real. And the logical response seems obvious. Stop the bleeding. Sell now. Get out while you still can. Wait for the market to stabilize. Then get back in when everything feels safe again. On the surface, this sounds responsible. It even sounds smart. But in reality, it is one of the most expensive financial mistakes a person can make. So what actually happens when you do nothing? The market falls, and your portfolio falls with it. On paper, you're down. But there's one critical phrase here. On paper, you have not lost a single dollar until you sell. A paper loss is not a real loss. It's simply a temporary change in the price of assets that you still own. Throughout American market history, every major crash, the dot-com crash, the 2008 financial crisis, the 2020 pandemic crash, all of them eventually recovered and went on to reach even higher levels. The people who sold during the 2008 crash permanently locked in their losses, but the people who stayed invested and did nothing watched their portfolios fully recover and in many cases grow far beyond where they started. But here's the strange part. If doing nothing during a crash is really the right move, then why does every instinct in your body tell you to do the exact opposite? Why does staying invested feel so wrong, even when history shows it's often the smartest decision? The answer has nothing to do with money. It has everything to do with how your brain is wired. And that's where things get really interesting